Hello, Matt. In recent weeks, inflation expectations and bond yields have ticked a little bit higher. Does the bond market seem like it's sensing something that the equity markets may not be?
You've picked up on a very interesting disconnect, and I think it gets to the heart of actually how we think about investing is differentiating between assets that are fixed in supply, whether it's gold bullion or whether it's businesses are well positioned versus those that are fixed in principle. And I think the problem for fixed income markets of late is that they've been dealing with these large supply shocks. One obviously in the energy space, the Strait of Hormuz is shut. But even beyond that, assuming that we normalize that in the next few months, is the fact that energy pricing may be a little higher for longer to incentivize production and development elsewhere around the world. So there's a risk premium that creeps into those pricing. And it's not just the direct energy effect, which is important, it's the fact that it flows through to fertilizer costs, the fact that it flows through to the cost of making cement, concrete, etc. Energy diffuses throughout the economy. And this is happening at the same time that we're going through a wave of deglobalization in manufacturing supply chains. And we have aging demographics, which is pressuring population growth. So, on the one hand, the bond market's dealing with this supply shock, made worse by the fact that we have very wide fiscal deficits, which are contributing to the inflationary dynamic. And so the question is, why aren't equity markets pricing this? I think in part because the mix of businesses today is such that there are a lot more strong market position services, software, network companies that have the ability to pass through nominal inflation over time. And so the equity markets may be a little complacent to this risk by virtue of what market participants are seeing bottom up. I think the second subtlety here is while bond markets may be pricing a little more inflation risk, they're not pricing much credit risk. And so if you think about equity markets, they're going to be beneficiaries of the view that we have some combination of low risk perception and financial repression ahead. And so I think that you've got to disentangle those signals when you look at the different performance of these markets.
Shifting to equity markets, if oil prices stay higher for longer, in your view, what types of companies might be most favorably positioned for that environment?
So there's certainly primary beneficiaries, and that would include the upstream energy companies themselves, whether you're an oil producer or LNG producer. There's the oilfield services companies. But then there's the sort of ancillary commodities. And I mentioned fertilizers before, but I think there's some more subtle second order consequences to this. So uh, companies that have high brand power, for example, perhaps in the luxury product space that don't have a lot of energy intensity but have a degree of pricing power could benefit from a more inflationary equilibrium if oil prices stay high for longer. You could say the same about a lot of commercial services, capital light software, et cetera. And so there are some businesses that may use that inflationary dynamic to get better pricing over time. There are other businesses where you may see some unexpected improvements. For example, imagine financials that have float. They have the use of other people's deposits or insurance premium paid in advance, but not a lot of credit risk. And so that could include property casualty insurance companies, life insurers. It could include settlement and custody platforms, where those companies will get, if interest rates are higher for longer, along with oil prices higher for longer, more income on their float. And so there's a range of these different companies that could benefit. But one of the things that you have to bear in mind is if oil prices stay high for longer, the question is how high? If we need high enough oil prices to destroy demand, then that could be a very different scenario because that's a scenario like the 1970s where risk premia need to be a lot higher because the markets have to start to price a recession. And that could be bad for multiples of some of these discretionary sectors. And the final thing I'll say is if interest rates are drifting higher, then multiples can drift lower sometimes in equity markets. And so we saw that again in the 1970s. And so it's one of those situations where you can prepare for the first order. The second order can be quite different. And then the third order, if you have really high oil prices, could be quite bad for everything. So it's kind of complicated.
Well, thank you very much for your time today, Matt.
Thank you.